Good afternoon, ladies and gentlemen. Thank you so much for taking the time to join our webinar on Personal Finance Masterclass. This is the third of a series of 4 webinars that we are conducting over this season. And I hope that you had an opportunity to be part of the first and the second masterclasses. Now, I see we have quite a number of us joining here, maybe in the next 1 minute to allow those who are interested in joining this call to continue trickling in. I see we are quite a huge number, but I believe there are so many more still joining. I want to encourage you to just, go to the chat and say hello wherever you are and tell us where you're tuning in from, just in 1 minute as we wait for the rest of the people to join us. We'd be very happy to know how you're doing because this is third time we are meeting, and it would be really good to know how are you faring on? Where are you tuning in from? How are you doing, in terms of your physical health, in terms of your financial health, so that we don't address only one thing. Thank you so much. We have a lot of greetings coming in. Someone from Athi River, another one from Westlands. Keep them coming. Oh, fantastic. We have Charles tuning in from South Sudan. We have Njoki from Juba. We have Emmanuel from Mombasa. We have Ken from Kajiado. We have someone from Kitengela, Nairobi. This is so interesting. Kikuyu, Mombasa, South Sudan, Nairobi, Rongai. I don't know whether that is still Nairobi. Umoja, Kiambu, Sylvania, I hope I pronounced that correctly. Nairobi, Kerenyaga, Bondo, Roysambu, Kampala. This is amazing. It is very representative, and I think that is very important because as we go into this conversation, we need to give perspective. We need the context of where you're tuning in from. We have someone from Addis Ababa, Syokimau, JKIA, County 001. Which county is 001? Just kidding. So thank you so much for making the time. Keep the greetings coming as we launch into this masterclass. I also hope that you had an opportunity to be part of the first and the second masterclasses. In the first masterclass, we discussed the basics of personal finance. I know Christine will be coming on to share a little bit more about that as she connects it to today's topic. But essentially, we looked at things like debt, budgeting, what is the health of your personal finances? In the second webinar, not too long ago, we also looked at something we called Investment 101, which was about the why, the how, and the when should you invest? What's your profile like? What is your appetite? How should you select where to invest? And it was a very interesting class because it is in that class that we had 3 people who walked away with some sizable fund to go start their DigiTrust money market account. My name is Paul Sagati. I'm going to be a moderator for this session. And I invite you to continue with this conversation, both here and with your friends, wherever they are. I know there are people who would be interested, but are not able to join. So you can use the hashtag Financial Literacy KE to tell people about what we are doing here today. And we'll be delighted to retirement planning KE, hashtag financial literacy KE, so that the conversation can continue from wherever it is you're tuning in from. So I want us to go straight into it because I can see we are quite a number and we do not want to delay. This is a very loaded webinar today. And in our third episode of the masterclass, we are talking about beginning with the end in mind and specifically understanding the time value of money. How much is the worth of your money when time is introduced as a factor? That is a very interesting conversation, and we have lined up a very interesting, knowledgeable panel to take us through this. But before we do this, I'd like to just tell us in just around 2-3 minutes, a bit of information about the organization that has put this together. ICA Lion Group, or ICA Lion Holdings, is a company that has 4 main subsidiaries. That is the ICA Lion Life Assurance, ICA Lion Asset Management, ICA Lion Trust Company, and ICA Lion General Insurance. The company started a long time ago in 1895. And you can see it's so many years on, and we are still pushing on with this conversation about creating and protecting your wealth. Presently, ICA Lion Group is spread across East Africa. We have presence in Kenya, we have presence in Tanzania, and we have presence in Uganda. So the four main companies under the ICA Lion Group is ICA Lion Life Assurance, which majorly deals with long-term life assurance products. I think the most that we are familiar with is the education policies. But one of the conversations we're going to be holding today is on pensions and retirement planning. And this comes straight from the life assurance company, together with the two panelists who are coming to talk to us about retirement planning. We have the general insurance company, which also provides solutions in short-term insurance. Those are annual renewable policies for your property, such as motor, travel, and such like things. We have the asset management company, which is the official sponsor of this masterclass series. And the most familiar product, I think by now, would be DigiTrust and the Unit Trust funds. But as they told us in the last webinars, there are quite a number of investment options that you can explore within the company. And then we have the trust company, which has held a webinar before, and I'm sure you'll be hearing a little bit more about it in the next webinar together with the rate company. And they deal mostly with estate planning. So if you want a legacy to be preserved, this is the team that can help you deal with that. So that is how we sit in Kenya. In Uganda, we have asset management, general and life, and in Tanzania, we have the general insurance company. I'd like to, before introducing the next, the panel that is going to take us through, I'd like to ask one of my co-panelists who's going to be silent throughout to launch the poll. There's a very brief poll that we'd like to have you look at. Yeah, I think the poll is live now. If you could just take a moment to quickly just fill in that poll. And then we will tell you what we look like from this side at the end of somewhere in between. The first question is the age you should start saving for retirement. I think the poll is fairly self-explanatory. Kindly just populate the poll. Yeah, thank you. And then we can continue with the rest of the presentation as you fill in the poll. So I'd like to introduce the two panelists today, and kindly, if you could give me the pictures of the two panelists in the next slide, if you don't mind. So we have two people. Today we are going for 50-50% gender balance, and we're not playing with that today. We have Christine Mutahi, who is an assistant general manager within the ICA Lion Life Assurance Company, and she oversees the group business development. Christine brings to the table over 18 years experience in talking about life insurance, talking about retirement planning, talking about the time value of money, which is what we're going to be conversing about here today. Together with Christine, we have Kennedy Odenyo also, who is the manager in group business development, within the life company. Kennedy is also a very experienced person, a very sharp knife in our drawer, having accumulated over 18 years of industry experience in the same conversation we're having. So cumulatively, we have a panel that gives you 36 years of tried and tested experience. I'd like to just save up on the remaining time because the conversation today is super, super interesting. You better be attentive because we will also be looking for the 3 most attentive students to award towards the end of this conversation. Kindly continue filling in the poll. Over to you, Christine. Thank you.
Thank you very much, Paul, for the great introduction. Even as we get into the conversation, I'd just like us to recap a bit. I know Paul has already touched on it, but just looking at the first two classes that we've had, I know we've talked a lot about the personal finance basics, and I'm sure most of us were in that class where we learned about understanding interest rates, understanding budgets, how to come up with emergency fund, how to get out of debt, which is very important even as we become financially wealthy. And the second bit, we spoke about financial resilience. And that was key because in times like this, and this is why we are here, to learn more so that we can be more financially wealthy. In times like this, when we've had, maybe we're just coming out of the pandemic, the COVID-19 pandemic, how do we bounce back from a financial setback? And we're taken through the various ways of getting out. I think there are about a number of steps. And maybe if there's anyone here in the audience who remembers how many steps you are taken through of bouncing back out of the financial setbacks, it will be good. Perhaps you may stand to win. And one of the steps was to set goals and to make a financial plan, which is very key because as the famous words of Benjamin Franklin are, if you fail to plan, you plan to fail. And as one of my colleagues says, my colleague in our business called Patricia says, that if don't make your failure to plan become an emergency for others. And so just looking at that and reviewing where we were as at the last time, the second session, I think we looked at the why we invest, the how, and even the when and in what. And we summarized the investment objectives as being preservation, capital growth, looking at accumulation, capital accumulation and income generation. And so we will pick up from there. But even as we do that, some questions, even before we get into where we are today. Did you know that only about 22% of the labor force currently, and the labor force is about 17.9 million currently in Kenya, only about 22% of the labor force is actively saving in a retirement plan, and that makes only about 3.2 million Kenyans. I am hoping that you're one of those 3.2 million Kenyans, and if not, then we are hoping that by the end of this, we'll be able to give you an opportunity to start saving towards your future. And did you also know that only about 7% of the population, and this was from a survey that was done by the Association of Kenya Insurers, that only about 7% of Kenyans were knowledgeable about insurance as at the point when they were doing this survey. And that's sad because as we look at where we are at, and we're doing this, I'm calling it the financial health check, as we look at where we are, if you're not aware of how to be able to perhaps navigate through the various uncertainties that happen, we're told that in life, there are only two constants, and that's death and taxation. And so I'm hoping that for these other uncertainties and these other constant changes, we are well prepared, so that at the point when a setback like retrenchment happens or an illness happens, someone can get into a severe illness and they're not able to recover, and that affects their income generation ability. So what happens to their family in such a case? If their family is fully dependent on them and they're not able to generate income because of this severe illness or because of this disability, what happens to the living standards of their family? And what happens to, if it's education for their children? And as we ask ourselves these questions, of course, a lot of us may want to not have these conversations until, because we hope that we have prepared adequately. But in a lot of times we are caught off guard, not being prepared. So having these conversations today, I'm happy that we are here, because then it makes us start thinking of what options we have and what available tools we may be able to have so that we can be able to see what is available for us. And so as we look at the age that we are retiring at, and I know we've asked that question, at what age do you plan to retire at? Some people, and I know the younger generation of late, there's a new movement. I don't know whether any of us are members of that new movement. That new movement is called Financial Independence, Retire Early. That means that you can have people retiring even at the age of 40 or even at the age of 35, assuming that they have become financially independent. And that would be a good thing if they were. But should any of these events happen, should retrenchment happen, have you accumulated enough in your retirement, in your emergency kitty to be able to last you for at least 9 months, as you were advised in the last sessions? Have you considered what can take care of you in case you are permanently disabled or in case you are put down by critical illness? Have you taken the relevant insurances to be able to take care of yourself? Again, as we looked at the steps of being able to be financially resilient, one of the last steps was that you need to cover your downside, and covering your downside is by making sure you have some insurance. I know a lot of us depend mainly on what our employer has put for us. And so that dependence on the employer, of course, is good, because if you have a group life cover, then it will be able to take care of any death. In the event of death, it will be able to take care of disability or even critical illness. But if you don't have, if you're not in the formal employment, or if your employer has not put up a group life cover, it's important for you to consider having some insurances. And we have various, and we'll be talking about some of them even as we continue with the conversations. So that's just a nutshell to introduce what our conversation is about today. And remember that it's a journey, because as one of the renowned IT tech guys, Steve Jobs, said, if you look really closely, most overnight success took quite a long time. So don't be alarmed if you have not prepared, if you have not thought about this. We are here so that we can have those conversations and to be able to see how best to plan and how best to position ourselves even for the future. All right, moving on. I just want to introduce us to this hierarchy of needs. It's a financial hierarchy of needs. And why I borrowed this from the Maslow's theory of human needs. It's important to just help us be able to create some strong foundation, some strong financial foundation. And so this chart mainly looks to explore the various needs at the various age bands. Some of them may collapse into each other, but that's okay because we are at different levels. But looking at the bottom level here, and this level is looking at the people who perhaps have just graduated from college, who are just starting out. And at this point, the basic need at that point is just to stabilize their cash flows. And stabilizing their cash flows means they may not even have much to save or much to put away in a retirement plan or in a money market fund. But we do encourage that from the lessons we learned in the first lesson, that at least 10%, even if they've just started, even if you're just starting out as a newly employed person or a fresh graduate, it's important to save at least, even if it's 10%, even in the money market fund in addition. Right. Obviously, then at that point, the rest of building up an emergency fund may not arise at this level. But moving on into the next level, and this level can be as from even the age of 25, and it can go all the way up to the age of 50, depends on where someone is, on their income levels and their objectives. All right, at this point then now, because we are assuming that at this point the situations are different, they've started having children, there's there is dependence from the children. So developing an emergency kitty is very important so that people are able to know that they can depend on, there's something to depend on, all right? And we also want to be sure that in case of anything happening, the dependents are going to have some way of survival, you know, without if the main provider is not there. We are also able to ensure that education planning is catered for at that level. We have, as we've said, maybe children have come in and someone now wants to be able to ensure that their kids will be able to go to the highest level of schooling, so they start saving.
Sorry, Christine, to interrupt.
Yes.
There's something you did to your screen that made it smaller and then brought us your notes on the side. Could you probably go back to?
Thank you for that. Thank you for that. Apologies for that. Tech challenges. Sorry. Sorry, sure. Give me a minute. Sorry.
No problem, no problem. Please go ahead. Perhaps as Christine is fixing that very small hitch, I've seen a few of us ask on the chat section for us to share the recordings from the past 2 webinars. And my colleague and silent moderator, Whitney, has dropped them. So please head over to the chat section and you can copy those and keep them somewhere so that you find some time to listen in, and then everything that is being said here today will fit into the picture later. And perhaps, Christine, you let me know when you're ready. But as she spoke, I reflected on some words that I had come across on retirement, and someone said, you know, as Christine was talking about the movement that is called financial independence relatively early. Are you okay now?
Yes, I'm okay. That's okay. All but right. You can continue. You can continue.
Yeah, sure. No, you're fine. Let's not eat into the class. I'll talk about that. So stay tuned so I can finish that story. Okay, back to you, Christine.
Okay, thank you. Right.
Not yet.
Okay.
You went into slide mode, then went back into. Yeah, that's okay now.
All right.
Yeah, thanks.
All right. So my apologies for that. As we continue, so we were on accumulating wealth, the 3rd pillar of the hierarchy of financial needs, and this is steps towards becoming financially wealthy. And at this level, the person is most likely looking at diversifying their investments. At this point, you're trying to generate more income streams, as we learned, you know, from various investment options that we have. You're trying also to ensure that your retirement fund is well off, it's stable, and to be able to take care of you. And so, if need be, you're building up and trying to make it bigger in case you realize that it will not be able to meet your retirement needs. And at this point also, most of the people are trying to ensure that they have paid off their mortgage in order to be debt-free by the point when they are reaching retirement, right? Again, the next level, and that's mainly from the age of 50. And remember, I said it can vary. It can be, some of them will be younger by the time they're reaching financial freedom. And I know a big question is usually asked on, or what is financial freedom, and what is, at what point do we say that we are, you know, financially free? And it would be assumed that at the point when you can proudly say you're financially free, it's a point when you're living off your passive income. You're not having to actively work to be able to earn an income. You're living off passive income. And did you know that the statistics show that in Kenya, I think we only have about less than 10% of people being financially independent. And so that's, we're hoping that even as we continue with these masterclasses, that a lot more people will get into that a section of financial freedom so that it stops being too narrow. And perhaps we can be a good point to have it as wide as the cash flow and basic needs pie, all right? At this point, a lot of needs there are medical care. And in medical care, there are many different avenues. Here we have in Kenya, we have some of the products that I know my colleague Kennedy will talk about at a later point. But we have critical illness covers. We have NHIF. A lot of people don't know NHIF can be quite handy even for old age. We have long-term care as well, and long-term care will involve even maybe some people subscribing to some nursing facilities. But we also have at that level also people taking vacation, you know, they are on retirement, they're taking vacation. Some of them are maybe just concerned about their children's well-off in terms of starting off life. At that point, perhaps some of their kids are getting married, and so they're looking at giving them an inheritance or giving them a wedding package, you know, home as a wedding gift or something of that. So those are the main needs at that point. Then we have, of course, the last step, which is what I have termed as legacy. And in legacy here, we are looking at gifting or distributing of wealth, or what we call estate planning in terms of how you distribute what you have accumulated all through. And I know we perhaps at a later point, we would have a more focused conversation on estate planning, but this is a key stage because it would be sad to have accumulated all that and then reach the end and have no plan, no succession planning, even for the businesses or for the wealth. So that's just a nutshell to try and see the basic pillars of financial or building your financial wealth or becoming financially free, right? And so the next conversation pretty much mirrors on what we have talked on the previous slide, but now I've looked at it from both an income and age perspective and the various levels of building wealth. In the last conversations in the personal finance and in the how to invest and where, we mainly talked about the accumulation and a bit of conservation. Today we're talking a bit more on the conservation and then also looking at how then to protect what we have accumulated and how to live on it, live off it, and then how to distribute it eventually. And so just as a summary, we talked about the age where, you know, the young people are just starting to work, the income may be very low, but at that point, the needs, the consumption needs are higher. As they move up the ladder in terms of income, they acquire a bit of debt. Maybe they're having their first mortgage, or they're buying a car, or some of them are just buying furniture and furnishing their homes, so they get a bit of debt. At that same time, again, also we see some of them now getting into family towards the late 20s, beginning 30s. And so at the family formation, then the needs sort of change a bit, because at that point where family comes in, then we need to immediately start thinking of insurance planning, because at this point now there is dependence and there's reliance on us. And so we have to think about how do we survive, how do our beneficiaries survive, or with their lifestyle change, with their education change, with their will they be able to still live in the same place that they used to live, or what would happen to them? And so insurance planning begins happening at around that same point. But at the same time, we are hoping that as time is going, they are also moving up their career, and you know, as the family development is happening, they've also moved up the career ladder and their income levels are a bit higher. And we're also hoping that they started saving earlier so that they're also starting to get some passive income. And so at this point, the the needs also are the financial capability allows them to be able to invest a bit more. There's now more focus on retirement savings, because at this point, the income levels are higher, but at the same time, the needs are also high, because I would imagine also there's a mortgage in that level. And then as we move closer now to the mid-50s, that's a point where now we're moving towards retirement. And so from building wealth to living off the wealth, to accumulating and to conserving and protecting, now towards going to retirement. And in retirement, you're living on what you have accumulated over the time. And at the same time, also, we are looking at estate planning, because as you go into retirement, we've talked about now looking at how to distribute wealth. Notice that the curve generally may go a bit down, but if someone has worked on the various pillars well, then they could actually, the income could actually continue growing, because it's assumed that the various income streams now coming from the diversified investment options will be able to give this person more sources of income. And at the same time, some of the expenses have gone down. Yes, we are saying that medical care has gone up, but because they had planned well, they have even some of the products that we'll talk about later, they are able to be comfortable and not necessarily live off lower income than they were before. At the same time, in retirement, maybe their social needs are taking more preference. They may have taken up some new hobbies, they're traveling, or maybe they have some new sports like golf. And so those are some of the interests that they're taking care of at that point. So in terms of even insurance planning, maybe it's just, domestic covers, travel insurance, golf insurance and such, but also at the same time while taking care of their medical needs, which we assume at that point they've invested widely. They have the various covers, they have NHIF, and they have post-retirement medical cover, they have critical illness covers, so that they are able to live comfortably and not completely exhaust their income, right? And at this point, then it's important for me to put a note that I'll quote Robert Kiyosaki, and he says that it's not how much you make, but how much you keep, and how hard it works for you, and how many generations you keep it for, okay? Not how much money you make, but how much money you keep, and how hard it works for you, and how many generations you keep it for you. That's Robert Kiyosaki. I think most of us from my generation grew up knowing about Robert Kiyosaki. All right, so moving on, we're almost getting to the end. And at this point, we just want to know what is your risk appetite or your risk tolerance. And why is this important? Because it's important to know what kind of an investor you are. Remember, we are saying we are working with the end in mind, and we are looking at the various things that would affect your income. And so trying to also see how the various investments would be affected in terms of, again, also time value of money. You want to be sure that what you're investing in now will still be valuable for you in the years that you retire, and to be able to carry you for the remaining part of your life, even when you retire. So understanding your risk profile is very important. This chart is not important. For me, what I just wanted to bring out to you is very important to know what your investment objectives are. Remember, in the last session, we talked about the various investment objectives. Is it capital preservation? And so if it's capital preservation, then your risk is very minimal. So you're the kind of people who will be very stressed to see any of your investments going down or going down in value in about 3 months. And so in such a case, you would not invest in anything like stocks or anything like Mutahi business because your risk appetite is low. But what about also if you only have about 5 years to retirement? So you're looking at your time or the duration that you have to invest. That's another important thing to consider, even as you're looking at your risk tolerance, okay? So how much time do you have to when you want to access that fund? What is your risk, your investment objective? You're also looking at how old are you? It would be hard for someone who is in their 60s or 70s and who doesn't have perhaps adequate, or who is not already at financial independence, or who is not financially free to be investing in very aggressive portfolios. All right, so you're looking at your age, you're looking at your income, you're looking at your investment objective, and you're looking at your duration in terms of how long you want to invest. And so that's just a summary so that you understand yourself as the kind of investor you are before you make any investment decisions. This can vary as time goes by. Some situation can happen that can make that vary, but at any given point, and even as you invest, even in our money market funds, we allow you to do that risk profiling test to just help you understand yourself. And that way, then you're able to invest with wisdom, with knowledge, and without having to panic and get sick every time the markets turn if you've invested in the wrong investment vehicle. All right, I move to my last slide, and here I'm talking about inflation. And inflation, very simply put, is the erosion of the purchasing power of money, okay, of a given time. 20 years ago, and I think I'm quite old because 20 years ago I was around and about, 1,000 shillings would do for us a full grocery shopping, actually a full month's worth of shopping if you lived alone, all right? Currently, I'm not sure how much 1,000 shillings can do for you, and especially if you have a household with dependents. And so this is pretty much what inflation does. I saw a joke last week about fuel, with some of us saying that we didn't know we could actually afford V-Power until last week. Just that now the price of V-Power is what we are paying for normal petrol. And so that's what inflation does. And inflation can be because of various factors, but mainly where the cost of producing goods and services goes high, and that pushes the suppliers to push the cost up and to spread the cost to us. At times also inflation is because of low availability of whatever the materials or whatever the products, and that again, the low supply also, this low supply and high demand then will cause the value of money to be eroded. So I'll want to end there, but I just want to remind us again, just making a quote, referring to a quote, more important than the how we achieve the financial freedom is the why. Find your reasons why you want to become financially free and wealthy. And that's by Robert Kiyosaki. You'd have noted by now that Robert Kiyosaki is perhaps one of my favorite finance gurus. But at the same time also, this was referred by my colleagues last time to just understand why you're investing or why you're saving or what your objectives are. We all have different objectives. We all have different needs, and we have different income streams or income dispositions. And so your needs may not be necessarily mine. All right. At the same time, look at the protection bit. It's very important. I know a lot of people have maybe not taken a lot of keen interest in insurance. It's very important because you want to be to maintain the same level of living standards that you had before the eventuality happened. So look at the various options that we have. We have what we call pure risk instruments that just allow you to be covered for insurance protection only. We also have others that offer both savings and protection. And that means that should a particular duration lapse, maybe you've been covered for 10 years or 15 years, you've taken a cover for 10 or 15 years, and the eventuality being death or disability does not happen in the 15 years, then at the end of that term, there's a particular lump sum available for you, all right? We also have the education covers, which are very important, that help in planning for our children's education, so that, as my colleague says, we don't make our failure to plan an emergency on our other colleagues. And so thank you very much. I will end there, and I hope that we continue to engage and hoping that by the end of it all, we will all be financially independent. Thank you.
Thank you very much, Christine. As you lower your slides and Kennedy puts up his, I'd just like to echo a few things that you've said. And, you know, Christine talks about just less than 10% of the people in Kenya have attained what is called financial freedom. And I'm looking at us in this webinar, and I see that that is just about, what, 40 people at most, you know? So we still have a lot of work to do. And I'd like to just hand it over back to Kennedy. Kennedy, over to you. Thanks.
Thanks. Thanks, Paul. Thanks, Christine, for that session. Actually, that is what we refer to as life stage investing, especially when you're looking at this session. And I'm really glad for everybody who has joined. I can see we are so many and people are eager. Now, the next part that we are going to look at is now the actual preparation for planning. So we've set the pace as far as life stage investing is concerned, where you are. But now we want to look at really, what is this retirement? In my own definition, I have a very simple definition of retirement, what it is to me. And that is, retirement is this journey to a land that is flowing with milk and honey, okay? So that journey or that destination of a land that is flowing with milk and honey, you have to prepare to go and join it. Unlike in the biblical land flowing with milk and honey, which was a promise, here we are talking about creating that land. So we want to be in charge of our destiny as far as retirement is concerned, and that's why we need to do the planning. And we have to take that into our own hands and create it. Now, a couple of things here as far as preparation is concerned. Number one, at that point, at what point do we start planning for retirement? The best time to plan for retirement is, or was, yesterday. And the next best time to plan is now. Not just today, it's now as we speak. So you should have that in mind. So I don't know the age profile of our participants here, but I guess some are young, some could be in the middle ages. But no matter where you are, I'll show you some calculator in a short while. No matter where you are, the best time to plan for retirement, if you've not started, is now. But I want to believe all of us who are savers in one way or the other, we have already started the journey. The reason why we say we are beginning with the end in mind is because we want to see really what is lying ahead of us in this land of that is flowing with milk and honey that we are all creating. One is that there are certainties that we have to be alive to. One of them is that you will need medical cover, or medical costs will be certain. So you must have your medical insurances or programs in place. Insurance people are also very funny. You'll find that at that time, very few companies will accept medical cards, or those who accept the medical will be quite expensive, or probably you'll be left for NHIF, with NHIF. So medical is a serious need, Because if you are in employment now, I can guarantee you that by the time you leave, your medical cover will be taken away. So we need to plan for that as soon as now. How will I take care of my medical needs? In retirement, we say cash is king. So forget about anything else. You need to be liquid. And you can only be liquid if you have money. And you can only have money if you are already planning through which vehicles you are saving. So you need to have money in retirement. And we'll be looking at some of those options that we have. I also want to believe that by the time you are retiring, if you looked carefully at the life stage diagram that Christine mentioned, there's a period within which you have a lot of debts, and that is between age 30 to 50. So that's the time you are planning to do a lot of things. So you're taking loans here and there. Please let those loans end by the time you have reached your retirement. Don't be these people who are in retirement and they are still looking for loans. You need to be debt-free. But you can have all that, but you are not active. So you need to also start thinking of what are these engagement activities that I plan to have, okay? So if you are thinking of side hustles in retirement, you better start them now so that things that will keep you busy. I know of people who, when they reach retirement, that's the time they go back to school, start their MBA or PhD programs to teach and the likes. So you really need also things that will keep you busy. You also need the social and psychological support, and we are going to see this in the next slides, as well as housing. Imagine now you are paying rent, you are active, you are maybe living somewhere in an apartment in Kilimani here, paying rent. I don't think that it is sustainable to do that while you have retired. So you also need to have programs on what to do as far as your housing is concerned. You need also to envision that housing. Is that housing going to be in the same setup in the urban setting, or is it going to be in the rural area? If it is in the rural area, are you duplicating the same features and facilities that you're already having here now in your rural house? Because you also don't want to get shocked. If you are used to a house with electricity in Nairobi, you don't want to go home in the village and you all of a sudden find yourself using the normal lamps that we used to use a while back. So make sure that you duplicate the same facilities you have here. If you are planning to have a holiday home in the coast or something like that, that will be used as your retirement, then you need to start it now. So that is why we think these kind of engagements are important. And when we say we begin with the end in mind, that is what we are talking about. Now, there are a number of things which is tied to what I mentioned earlier as far as retirement preparation is concerned. Financially, we all agree that cash is king, so you really need to have money. Yeah? And besides money, what we are doing today is very critical because we are giving you the financial literacy. I have talked to a lot of people who are retiring or who have reached retirement, and then the first thing they tell you is, I wish I knew, or I wish I had some of this information earlier when I was active, I could have saved more. So consider yourself in a privileged position that you're able to have this kind of financial literacy early in advance so that you prepare for yourself. There's something called income displacement ratio, and we are going to look at that in the next slide, and we'll even show you what is the ideal, okay? And then all these talks, financial planning talk leads to something called goal setting. So you really need to have your goals clear, set them, have personal scorecards, just like you have one for the company if you are in employment. There's no reason why a company can have a scorecard for you, yet you don't have a personal scorecard for your own life. And make sure that the goals are written down. And I believe those were covered elsewhere. But it is possible to have finances, you are liquid and you have everything, but you're not psychologically prepared. I've seen even colleagues here who have reached that age of retirement, but they are not prepared. They're asking me, what am I going to do? And this is why we are saying you really need to come alive to the fact that each and every day, we all grow closer and closer to our retirement by default, whether you like it or not. Yeah, I started saving in a scheme about 20 years ago. I think I've like saved half of my journey towards retirement. So we need to prepare, accept when the time comes. We don't, if you are in employment, you don't be the kind of staff that will be asking HR for extension or contract extensions, okay? Simply because you're not psychologically prepared to go out in the world and face the world. So that's where soft landing activities come in place. And the other thing that is also alive here is stress. I've noted that stress really is not a respecter of money. The people we think have money actually sometimes have more stress than those who don't have, or those who have less. So you also need to avoid stress in retirement as part of planning. The next one, which is related to psychological, is also social. This is just having friends, close family support. You know, we are human beings and we need to interact. Someone once told us that as a couple in retirement, you have a lot of time to talk. So that is why it is very important to have that kind of support in place. And then the last one is, in my view, is dependence. Sometimes it's possible to have a dependence in retirement, but if you've planned very well your life, then you make sure that your children become independent by the time you are also retiring. Otherwise, you may end up having a situation where you have retired and you have a 30-year-old who is still living in your house, is giving you stress, he has no work to do. So it all boils down to ensuring that those dependents or children you parent responsibly, and by the time you're retiring, they are also probably the only people you can have in the house are grandchildren. Okay, so that is very key. We also need to cut this cycle of dependency, where sometimes we rely on our children. If those who are working, we rely on our children as the retirement fallback. I know most of us in this call, every end month, like we are approaching, you expect to send some money in the village. Yeah. So let's be the generation that cuts that cycle, where now probably it will be the reverse. By the time you are retiring, you don't expect anything from your children if you have. And if anything, you will be probably the ones supporting them. Now, if you avoid all that, then you will not fall into the trap of what we normally call as retirement poverty, where you don't have money, or you have money, but you are psychologically not stable, you are socially not fitting in the society, and you have a lot of dependents. You can have money, but the dependents are giving you a lot of stress. So all those things form part of retirement planning, as it were. Then this just summarizes what I've just mentioned, so I don't need to repeat it, but it is all in the same. What kind of legacy do we want to leave at that point of retirement? The replacement ratio we are going to look at. The risk appetite, which is the risk profile. You know, as you age, you tend to have lesser and lesser risk appetite in terms of investments for risky assets, and we are going to see products that are available that may suit you depending on where you are. So that is basically part of what retirement preparation is and what you need to do. You just don't think that in terms of retirement preparation, it is a one leg of finances only. We also have other aspects of it that needs to be brought into together. Now, people always ask, what is this? What is the ideal amount that I should have at the point of retirement? And this is where this concept of income replacement came in. Remember, a while back, when we used to have those who are old enough, when we used to have pension schemes that were called was structured in what we call defined benefit nature, the issue of income replacement was not really a problem, because by the time you retired, you would get your last income, or your last income would be mirror really what your last pay slip was. Yeah, it would be probably 80 to 90% of what you are earning before, because the benefits were defined. When you are working, you knew from the word go that when I reach my retirement, I would be earning 70% of my last pay slip. Okay, that changed when now we switched to what we now refer to as defined contribution scheme, where we only know what we are contributing, but we really don't know whether it will be adequate at the point of retirement or not. Okay, so that's why it is very important to understand this concept of income replacement early in advance, because you could be saving, you could decide you're saving 1,000 shillings. But is that 1,000 shillings adequate? So what do we use really to determine what is adequate and what is ideal? The ideal situation, if you ask me, is I should have a replacement ratio of 100% and above. And this is why I think, I suspect some of the tourists who come here and stay for months at the coast, this is where they are. They are in the replacement ratio of 100% plus. Yeah. But since we are not in an ideal world, most of us would need to target anything 60% and above. The reason why we have that drop is because we assume that most of your responsibilities are taken care of. You probably are not paying rent, you don't have any loans, so you can really survive on at least 60% of your pre-retirement income. Okay, so basically it means if I'm living today, this is my last pay slip, I'm earning 100,000. Subsequently, when I step into the world, whatever I will have consolidated from my savings, including probably other income streams, should keep me going by at least 60%. But remember, don't settle for the targeted. Always strive to have the ideal, where you are actually happier in your retirement than when you are working. And that only comes when you are having a replacement ratio that is slightly above 60%, 60, 70%, compared to what is currently. What you see down there in that slide is what a research that was done from by RBA, and it showed that most retirees in Kenya have a replacement ratio of less than 30%. Some cases it goes as low as 10%. Somebody tells you, I was earning 100,000, but now I've reached my retirement, I'm getting a pension of 10,000 shillings only. So how am I going to survive? So you ask them, did you save more? Were you doing additional voluntary contribution? Were you in a circle? Were you did you look at these other investments? Then they'll tell you, no, we didn't have anything like that in our time. So always remember to target a replacement ratio, an ideal one of 100%, where you will have more. But if in a worst case scenario, work with at least 60%. So that means you need to plan your other activities around a replacement ratio that would make you comfortable in retirement. Okay? If you have a replacement ratio of 100% and above, that's probably the time now you will need, if you've never taken leave, if you've been in business throughout, this is the time now you will start becoming an international tourist. So you'll be going all over places to enjoy your life in retirement. Remember, I mentioned that it should be a land flowing with milk and honey. So you can't flow in milk and honey when you are looking at a replacement ratio of 30%. That is retirement poverty. You need to be in an ideal situation of 100 plus. to achieve that. Now, we've talked about the ideal, the replacement ratio, what we think is how we should plan and the needs that are there. But what are some of the vehicles that people are currently using as far as retirement is concerned? And remember, every time I talk about saving for retirement, don't think I'm talking about saving for retirement to the exclusion of your other investments. I'm including other investments, including those who probably think that they can save, put money in a bank deposit. So all those are part, as long as you are disciplined enough to save. NSSF, I know probably if you're in a formal employment, majority of us fall there. But I'm yet to see anybody who has achieved, probably has gotten more than $500,000 in NSSF, in savings under NSSF, except those who are, NSSF currently is also accepting any amount of contribution, not just the basic 200. So any amount of money you put there, you're able to get. So that's a universal one run by the government. We have people in employment, those who are in employer schemes. You know that you can save through retirement schemes or programs that are there. Then we have the ones that are now at personal level. You can choose, nothing stops you from having the three. You can be a member of NSSF, you can be a member of a personal pension, you can be a member of an employer scheme and still have your own personal pension account, which is very good, and we are going to talk about it in the next slide. So those are some of the retirement products that are regulated by RBA, and that brings in the element of security. And those ones, the first two, help us in what we call accumulation. So you are not taking out anything, you are accumulating your money, and these ones are ideal when you are working. The next two, what we call the annuities and income drawdown, those ones are for decumulation. In other words, the money that you worked and accumulated over time now is used as lump sum to pay you, okay? And we will show you how that works. But we have two other additional concepts that have also been brought in that can help you also plan for your retirement. Remember, I've talked about medical needs. There is a feeling that this is becoming an emergency. So Retirement Benefits Authority has allowed schemes, people, those who are saving through a retirement scheme, personal retirement and the likes, to also start saving a portion of your money, putting aside a portion of your money towards post-medical retirement, and we'll talk to that. In the same breath, because housing is very critical, what has been happening is that people have, we've seen people who have reached retirement and then that's the time they start building their retirement home. Now you have a room where you can use your money that is in the scheme to save, rather to help you in the mortgage process. And we will also be showing you or talking about that shortly. So what are these IPPs or personal accounts? These are just retirement accounts that are opened, a retirement savings account, but unlike a bank account where you put in money and you withdraw anytime you want, you get a loan, these ones don't have that kind of, or they don't have those kind of options. These are long-term savings with the objective of locking in money specific for retirement, and retirement in government is considered anything between age 50 and above. For our case, we say we think up to 75 is good enough, though I know there are people who are still active even beyond age 75. Then the beauty about these personal pension accounts is that they are flexible in terms of contributions, in terms of frequency. So you will not have, you can open an account with as low as 1,000 shillings, then you start contributing. Today, tomorrow you don't contribute, next month you don't contribute. If you bring in lump sum, you can bring in lump sums. In fact, for those people who have been changing jobs, I would encourage you to open a personal retirement account where you consolidate all your funds from previous employer into one kitty, yeah, rather than leaving them all over, because there's a risk that if you are, one, you can forget. The other risk is that in the event you are not there, your beneficiaries will really have a lot of trouble chasing those funds. So these accounts, funds are invested. For insurance companies, we provide guarantees with a minimum rate. And then if you are in employment where there is no, the employer is not participating, it's also possible to involve your employer in it. Then just give me a minute. Let me see if I can show you a calculator here. Are you able to see this? Christine can confirm.
No.
Oh, sorry, I'm not.
Share your entire screen.
Okay, let me, allow to.
And perhaps maybe Kennedy, as you do that, we are just 22 minutes shy of our time, so perhaps you can just quickly go through the remaining.
Yes,
section.
actually, I'm through. Now, I just wanted to show this, because some people will ask, how much do I contribute? So if this calculator will be available to you, if you say, and the things that you will be considering are just the years to retirement. So let's say I want to retire in the next 20 years. So I'll put in 20 years, and I want to put in 30,000. So here you'll see already the expected fund at retirement would be 22.6 million. Okay. Then remember we talked about inflation. So you can also decide that 20,000, 30,000 today is not the same like 30,000 in 20 years time. So maybe I will be increasing, I'll be escalating my contributions, maybe by 5%. Then you will see that the accumulated fund now changes to about 32 million. We have also those who will want to begin with the end in mind. Then you say, I want to have 50 million at the point of retirement. How much do I need to contribute now? Okay, so you will work it backwards, and then the amount of monthly contributions that you will be expected to do is indicated here. Now you will notice that the younger you are, so the more time you have to retirement, say if I have 30 years to retirement, the better it is for me in terms of lessening my contribution. If I'm very close to retirement, like 5 years, I would really have to struggle to put in more contribution, okay? So that is just one thing I wanted to share with you before now we go back to our final slide that we were showing here. So that is why I was showing you the calculators that we will also share with you, just to help you have that picture in mind. This one is more or less the same. So this is also another calculator showing the contributions. So this is straightforward. When you save into a retirement scheme, we have tax benefits. Tax benefits come in by way of, there's a maximum tax deductible amount of 20,000. So the contributions up to 20,000 are tax deductible, meaning you pay less tax on that. The investment income that is earned is tax exempt from corporation tax. For those who are above 60, when you get pension, it is 65 rather. When you get monthly pension, it is tax-free, even if it is $1 million. Okay. Then for the annuities, this is just a product that is used to decumulate, meaning it is used to, you bring in a purchase price, and in exchange, we promise to pay you income for life. So if you bring in 5 million Kenya shillings, and I'm using that as an example, this is what you are expected to earn on a monthly basis. from us, and it is income that is payable for life. So the columns represent the guarantee period, which are the minimum periods within which the pension must be paid. So if you choose a guarantee period of 20 years, then we are saying we'll pay you 44,000. This is indicative for at least 20 years and lifetime thereafter. So whether you live for another 30, 40 years, that is not your worry. So that is one way of planning your liquidity in retirement, okay? And you can choose to beat inflation, you can choose to have the pension increasing by certain percentages, 3, 5% every year, okay? Remember, pension stops on death or guarantee period, whichever is later. So if death occurs within the guarantee period, then the balance of the guarantee period is payable to your nominated beneficiary. The other product, which is called the income drawdown, is used to, unlike the annuity, the income drawdown is your fund. The annuity is our money. The income drawdown is yours. You deposit it, we invest, you draw it down. But there are two rules that you need to observe: that the drawdown must last at least 10 years, and the maximum you can draw per year is 15% of the fund, of the opening balance every year. So at least it helps you manage your fund for the next 10 years post-retirement, okay? And whatever will be left after that is, you can take it in lump sum, or we continue drawing it down. So like in this example, you bring you are age 60, you bring 5 million, then you start drawing down. Maybe per year you draw down 750,000, which is the maximum allowed. As you draw down, we'll be investing the money. We credit maybe 655, 465 by the end of the year. You are left with about 4.7 million. Then we begin the process again. You see, it is a stress-free also way of managing liquidity. Other than giving you this 5 million into your account, I can guarantee you, if you have that 5 million in your account, in the next 2-3 years, the money will not be there, okay? So those are some of the retirement products that we have that we can discuss with you in detail. As I finish, on the mortgage and the post-retirement medical products, these are facilities that ride on the pension schemes. And for the mortgage, there are two ways. You can use up to 60% of your fund as security, meaning there's no money moving within the fund. Or you can choose to use up to 40% of your balance, subject to a maximum limit of 7 million, to purchase a house outright. So if, for example, in your pension account, you have 10 million, and you've identified a house worth 4 million, and this house is ready for occupation, and it is being sold by, let's say, housing finance, then you go there, you sign papers, then we will pay for you that 4 million, and you walk into the house. So you'll already ride on the benefit of saving into a scheme to achieve the objective of having a house while active and saving for retirement. So those are products that are available. Then on the post-retirement medical is just another account. So if you are saving 10,000 today, you can as well add and say 10,000 for the retirement account, and then another 2,000 will be going also for the post-retirement medical account. So when you reach retirement, you will be having your 10 million savings for retirement and your 1 million that is money for post-retirement fund that you can now use, approach any of the medical service providers, and you agree on the medical packages that are available for you. This way you will have managed the stress of not having a home, and 2, not having enough cash for medical facility. Okay, so we thought those are some of the things that you need to do. Remember, we are talking about, this topic is about beginning with the end in mind. So the end in mind is you need a house, you need medical cover, And you need to start preparing this side of the year of life when you are still active in employment. Okay, so that is it from us. And this is what summarizes what we have talked about, what Christina said, what I've mentioned, is that you have to envision your retirement. And like we have said, the vision must be written down, okay? Like the good book says, you have to write it down. And you need to look at the financial health check. Where are you today? Are you happy with what you are seeing, with what you have? Yeah? You need to plan, when do you want to retire? And like it was mentioned, it is not really, it doesn't have to be tied to a specific year. You can choose to retire at age 40 and you're happy with it. You can choose to retire at age 75. What is important is how much you are prepared. And we have provided you with all the tools, all the products, at least for now, that are necessary to take you there. Thank you very much. Paul, back to you.
Thank you so much, Kennedy and Christine, for that very elaborate presentation. I think that if not for time, we would have continued to dig much deeper into it. But it is good for us to also keep our end of the promise to you for attending this webinar. So we'd like to just reflect on the poll before we come back to the questions you've asked, as Kennedy and Christine take a cup of water. The first poll question was, at what age should you start saving for retirement? And majority of us, 78%, believe immediately I start earning money. There is 15% who believe between 20 and 30 years. There is 1% that actually believes you should save for retirement when you're above 50. That is a very interesting answer. What is your retirement plan? So we have 6% of us who believe that our children are our retirement plan. We are taking them to school so that they can feed us when we are grizzled. But a good thing is 76% of us believe that our savings are our retirement plan. There is a minority, but very important one, of 14% who believe who say they have no retirement plan. We really hope that after this session, you will consider to set up one retirement plan so that you can save for the golden years. Then here is an interesting question on what do you want to do when you retire? Majority of us want to travel the world when we retire. So that means you need to save up a bit much more. 21% believe that they will go into farming. 16% will start a business. Considering what Kennedy has said, then you need to start doing these things before you go into retirement so that you're not stressed. But there's a 7%, the 7% of us who say they want to survive when they retire. Or is it, okay. Then there's also a small number that say they have no idea what they want to do when they retire. Perhaps it's a good thing to think through so you can have goals. And then what is your biggest challenge in saving for retirement? Taxes have been cited as a very big challenge at 34%, followed by income. I don't earn enough. And then there is a very big percentage that says I do not have enough information on retirement. I think we should do something after this session. Are you saving in a registered retirement scheme? Yes, 68%, no, 28%. And then 4% says, what are those? So they don't know what retirement, registered retirement schemes are. Where would you like to retire to? 30% of us would like to retire to the village. 33% would like to stay around Nairobi and other urban areas. 12% want to live in the beach. And then there is 25%, a quarter of this population would like to be global citizens, travel the world, see places and all that. Very interesting insights here. And I hope you also glean in and see some of the things. Now on to something interesting. We promised you at the beginning of this session that we will have someone win some money that will help you to set up a money market fund or top up your money market fund if you already have one with us. And why money market fund? Because remember right from the start that DigiTrust is the sponsor of this masterclass series. So I want to throw my first question, and I'd request Catherine to type the question out on chat. And the first person to answer the question correctly will receive the award we are talking about. And here is the question. From the conversations we've had from Kennedy and Christine, what percentage of people in Kenya have invested in a registered retirement scheme? What percentage of people in Kenya have invested in a registered retirement scheme? I will count on my able team of silent moderators to give me the right answer. Okay, coming in thick and fast. Second and last question. I think we can close that one. We also need time to respond to your questions so that we don't do all the talking and all the asking. We need to give you time. The second and the last question is, when Kennedy presented, he talked about something called a replacement ratio. Now the question is, according to research that he shared, what is the average current replacement ratio? What is the percentage current? Most retirees retire at what percentage of replacement ratio? Thank you very much. So it depends on time because both questions are percentages. Now it depends on time. We will announce the winner. And now I'd like to go to our panelists. We have 7 more minutes within our time, so we can focus on the questions you asked. I'd like to perhaps shoot a question to Christine as Kennedy relaxes a bit. Remember, he said something that, you know, insurance people are funny. And Kennedy has been an insurance person for 18 years. So that was a very interesting one. So someone asked whether we can share the slides. Absolutely, those ones will be shared with you. Now, this question from one of our students, because this is a masterclass, Christine Alan Jenga asks, in accumulation, what is referred to as enough? What should be enough when you're accumulating? I think that came from the life stage investment that you talked about. Over to you. Thanks.
Thank you. Thank you, Alan and Paul, for the question. Well, accumulating, and I think that's a main conversation that Kennedy took on income replacement ratios. You need to first think with the end in mind, as we have been talking about. You need to think about what are your expenses, or what expenses do you envisage to have at retirement, so that you're working with that budget, so that you sort of do your post-retirement budget, all right? Okay, so once you have identified what your expense items are, then you need to be able to cover all those items and still have something to take care of your social and to take care of your entertainment, right? So when you're doing your post-retirement budget, because we did do the budget in the first class, look at that and remove some of those other things. Of course, the taxation it has gone down a bit, and that's what Kennedy is talking about. Bare minimum, 75% of what your current or what you're earning just before you retire. Then now we work using that retirement calculator to find out how much lump sum do you need to be able to buy you that income. So that is what is deemed as enough, quote unquote, to be able to take care of your needs after when you're no longer working actively. Have I answered or lost us?
No, I think you've answered, particularly in the context of retirement planning. Thank you so much for that. Kennedy, I'd like to send this to you. We have someone who's anonymous, but I'd like to ask so that anyone else on the call can benefit from the answer. He has worked, I assume it's a he, but could be a she, has worked in a different country for 10 years and contributed and saved up substantial amounts of money through the National Retirement Scheme. However, they've not been able to move their funds from that country into Kenya. How can that be sorted? Perhaps you can speak to the whole conversation of QROPS and any other facility that exists to help people who work elsewhere move their funds, retirement funds, into Kenya. Kennedy.
Yeah, thanks. I think to answer briefly, if that part that the client has worked in UK, yeah, then we have an arrangement or a product that facilitates the movement or transfer of retirement pension funds between UK, those people who have worked in UK and Kenya. If it is outside the UK, then it will depend on each country's individual rules or requirements. Because for Kenya, if you are a Ugandan and you have been working in Kenya, you are considered an expatriate. So anytime you leave, you go back to your home country with all your funds. Okay, and there are no restrictions in terms of transfer. So I think the client can side chat us. We get more details, then we assist where possible.
Thank you, Kennedy. I think he's done exactly that. We'll be getting back to them. Sarah, we will share the calculator with you, perhaps on email after the whole session and everything else is done. One question for Christine and Kennedy, because time is not on our side. And then, like we promised, we will compile all your questions into one document. And then after the last masterclass, which is on 7th of October, we will send you that package with all the questions for you to refer. But for now, there is someone who wants to know the difference in very simple terms between an annuity and an income drawdown. Perhaps Christine, you'll help us with that. And then maybe Kennedy, the last question that you can address within the time we have is to speak to the tax of personal retirement scheme. Someone asked about if I contribute above 18,800, how is that treated in terms of tax benefits while contributing? Christine, over to you.
Thank you, Paul. The main difference between an annuity and an income drawdown, an annuity product is a lifetime contract between the pensioner or the person who is retiring and the insurance company that they have bought the annuity product from. An annuity product is a contract for life. What that means is the marriage is till death, do we part, such that if you have bought it with ICEA, we will, in exchange of your lump sum, pay you a monthly income for as long as you live, you being the principal member. An income drawdown, on the other hand, is a contract with any registered income drawdown provider, not just insurance companies, any registered income drawdown provider, and it locks you in for a minimum of 10 years. And what happens is that you exchange your purchase price or your lump sum with the provider, and they pay you at a drawdown rate that you choose, up to a maximum of 15% of your total amount every year, right? The contract is for a minimum of 10 years. There is one flexibility in this kind of a product, that if you're unhappy with that provider, you can actually port your product to another income drawdown provider who is registered by the Retirement Benefits Authority. That is different from an annuity. An annuity, you're bound for life. An income drawdown, you can actually move from one provider to another as long as it's within the 10 years. And after the 10 years, you can actually access your lump sum, the balance of your lump sum, or you can continue drawing down, or you can buy an annuity. That in a nutshell.
Thank you, Christine, for answering that. The conversation on annuities and drawdown is deeper. And we even have a lot of very simple content on our website where you can read about this, but also reach out to any of us for additional information. But remember, we also said you can engage us on social, Financial Literacy KE, hashtag Retirement Planning KE, and we could still answer those questions on our social media platform. Kennedy, you have the privilege to close it up by answering the question on tax benefits and limits.
Yes, thanks, Paul. tax is a bit complicated, and we deliberately reduced our slides to one just to make it simple, but we could go on. But as there are two levels: taxation at the point of contribution, where KRA has allowed a maximum tax relief of 20,000, including 200 shillings for NSSF. That's where the 19,800 comes in. So when you contribute that, assuming you are earning 100,000 shillings and you have contributed 20,000 into a scheme, in payroll terms, at the point of pay, when taxation is being done by the payroll person, you are not taxed on the 100,000. You are taxed as if you are earning 80,000. Okay? Meaning you will pay less tax. Now, that money you are contributing is what we call registered, because it is allowable, is tax allowable. The investment income you receive, when we declare 10% on that 20,000 that you brought into the scheme, that 10% is not taxed, okay? So you have been exempted at the point of contribution, you've been exempted at the point on taxation at the point of income, but when you are living for that portion only, then there are tax tables that is applied at the point of living. Now, what if I am contributing 30,000? Okay, same thing, 20,000 will be allowable for tax, including NSSF, but the excess, the 10,000, you will not enjoy any tax relief at the point of payroll, okay? And the investment income, when we receive it, when we declare 10%, we will pay tax to KRA, which is a corporation tax to KRA. But at the point of leaving, when you are leaving the scheme or retirement, there is no tax at all on that portion. That's why for those people who normally contribute beyond 20,000, you will find that you have two statements for the registered fund and the excess or the unregistered fund. The unregistered fund, you take the amount of money as it is because it has already been subjected to tax. The registered fund is what is subjected to tax at the point of living. Thank you.
Yeah, I think that is a very deep conversation, the way you said. Maybe food for thought for us to consider just putting together a session that looks at taxation from money market funds to pension to, trust services, estate planning, because it seems to attract a lot of questions every time we have a conversation. So as we come to the end of this presentation, I'd like to request one of the other moderators on chat, if we have the winners for the two questions, question 1 and 2, kindly let me know. Do we have anyone?
Yes, winner for question 1 is Byron Mutahi.
Thank you. You said Byron?
Correct, Byron Mutahi.
All right, thank you. I hope we reach out to him for, is it him or I'm not sure, but for the contact so that we can either top up your money market fund or start a new money market fund for you. Who's the winner for the second question?
We're still in the process. Kindly allow us to confirm that.
Okay, so we'll reach out directly to the winner. I think the answers came in thick and fast, showing that people were really paying attention. So we will still load up the recordings for this session and send them to you on email like we've done for the others. We sincerely thank you for taking the time to stay hungry and get informed. Remember what Kennedy said, pension is the land of promise, or is it the land of milk and honey? But the difference is there is no promise, you have to work for it. Thank you for your time. Thank you for attending. Until next time, have a wonderful afternoon from all of us here at ICA Lion.